Something unusual is happening in the metals market right now, and the lab has been tracking it for months. Silver is moving. Not slowly, not steadily, explosively. And the data suggests this is just beginning. While gold quietly broke records hitting over $5,000, silver started acting like gold on steroids. Citi analysts just predicted silver could reach $150. Let's break that down in the lab. You've heard this feeling before. I missed Bitcoin. I missed gold. I missed real estate. Sound familiar? That missed the boat feeling is exactly why silver is going viral right now. FOMO is a powerful force, but in the lab, we don't invest on feelings. We invest on data. So, what does the data actually say? Silver isn't just a precious metal. It's an industrial metal. It's money. It's a speculation vehicle. It's all three. And that triple identity is exactly what makes this moment so unusual. Industrial demand meets monetary panic. Over the next few minutes, we'll analyze everything: the ratio, the demand, the risks, and the real opportunity. No hype. No get-rich-quick promises. Just the lab's honest analysis of what's actually happening. Because the silver story of 2025 and 2026 isn't about yesterday's prices. It's about tomorrow's demand. Fair warning, silver is volatile, extremely volatile. We'll cover why that matters, how to handle it first. We need to understand one crucial metric that veteran metals investors watch obsessively. It's called the gold-silver ratio, and right now, it's collapsing. That collapse is the story. The ratio tells us how many ounces of silver does it take to buy 1 ounce of gold. Recently, this ratio dropped from over 80 to below 60. In metals terms, that's a seismic shift. When the ratio falls, it means silver is outrunning gold. Silver is gaining ground. Silver is catching up. This has happened before. Each time the ratio collapsed, silver experienced explosive moves. History rhymes, so let's enter the lab properly. We'll examine the three forces driving this potential silver supercycle. Before we analyze today's setup, we need to understand silver's dramatic history. It's wilder than you think. In 1980, two Texas oil billionaires tried to corner the entire silver market, the Hunt brothers. They bought so aggressively that silver went from $5 to $50 per ounce, a 10x move. Then the regulators intervened. The exchange changed the rules. Silver crashed. The Hunts went bankrupt. Lab lesson number 1. When someone tries to squeeze a market, the market-hand regulators fight back. Fast forward 3 decades, silver mostly slept. Trading sideways, boring. Until 2011 woke it up. After the 2008 financial crisis, central banks printed money. Investors fled to precious metals. Sound familiar? Silver hit $49 in 2011, almost matching its 1980 high. Investors thought this is it. Then it crashed again. For 10 years, silver wandered in the wilderness. Below $20, forgotten. Then 2021 happened. Reddit's Wall Street Bets turned their attention from GameStop to silver. The first squeeze attempt, thousands of retail investors piled in. They bought coins. They bought ETFs. They tried to squeeze the shorts. It didn't work. The silver market is massive. Too big for retail alone to move. The squeeze fizzled. Lab analysis. The 2021 squeeze failed because retail couldn't drain the massive above-ground silver stockpiles. The COMEX vaults held billions of ounces. Retail buying was a drop in that ocean. Not enough pressure, but this is crucial. Something changed between 2021 and now. The supply picture transformed dramatically. Those massive stockpiles, they've been draining. Industrial demand has been quietly eating through the reserves. COMEX registered silver has dropped significantly. The buffer that protected against squeezes is shrinking. Lower supply plus rising demand equals, well, you see where this is going. Squeeze 2.0 conditions. This time, it's not just retail gamblers. It's industrial consumers who genuinely need the metal. Different dynamic. Now, let's examine exactly who needs silver and why their demand is creating this structural shortage. 3 megatrends are devouring silver: artificial intelligence, solar energy, and electric vehicles. Let's examine each. First, AI. Every advanced semiconductor requires silver. It's the best electrical conductor on the periodic table. AI data centers are multiplying globally, each one packed with silver-containing components. Demand is exploding. Chip production is projected to grow 40% annually. That's 40% more silver demand. Every year when you hear AI boom, think silver demand. Every GPU, every server, every connection point uses silver. Second megatrend, solar power. Solar panels use silver paste for electrical conductivity. Lots of it. Solar installations are accelerating worldwide. China alone is adding record capacity. Each panel needs silver. A typical solar panel contains about 20 grams of silver. Multiply by billions of panels. Do the math, solar silver demand doubled in 5 years. By 2030, it could consume 20% of annual silver production. That's not growth, that's a structural demand shock. Solar alone is reshaping the entire silver market. Third, megatrend, electric vehicles. EVs use roughly twice as much silver as traditional gasoline cars. More electronics, more connections, more batteries requiring silver. The EV transition is a silver transition. Global EV sales are projected to reach 50 million annually by 2030. That's enormous silver demand baked in. AI plus solar plus EVs equals an industrial silver supercycle. 3 megatrends pulling in the same direction. The silver market has run supply deficits for 3 consecutive years. Demand exceeds mining production. Mining supply grows slowly, maybe 2% annually. Demand is growing much faster. The gap widens. New silver mines take 7 to 10 years to develop. Supply can't respond quickly to demand spikes. Here's the kicker. 70% of silver is a byproduct of copper and zinc mining, not primary production. So even if silver prices rise, miners can't just mine more silver. It's structurally supply constrained. The lab's industrial demand conclusion. It's structural. The supply-demand math is undeniable. But silver's story isn't just industrial. There's a second demand driver, money. Silver as monetary insurance. For 5,000 years, silver was money. Real money. Before paper, before digital silver coins circulated everywhere. Spanish pieces of 8. British shillings, American dollars. Silver was the backbone of global commerce. Then governments replaced silver money with paper promises. Later, digital entries. Money became abstract. Now those paper promises are being printed in unprecedented quantities. Trillions created from nothing. As currency supply expands, each unit buys less. That's inflation. Silver becomes a hedge against that dilution. When real interest rates go negative, meaning inflation exceeds bank rates, holding metals makes more sense. Investors, seeking safety from currency debasement, turn to gold and silver. It's happening now, accelerating. Central banks themselves are buying gold at record pace. They're hedging against their own currencies. When central banks buy gold, investors ask, if gold, why not silver? Silver follows gold with leverage. Silver is leveraged gold. When gold moves 10%, silver often moves 20 or 30%. Higher volatility, that leverage cuts both ways. Bigger potential gains, but also bigger potential losses. The lab never forgets risk. Gold just hit all-time highs above 5,000. Silver remains far below its 2011 peak. The gap is notable. Relative to gold, silver appears historically cheap. That's what the falling ratio tells us. This time, both retail and institutional buyers are interested. That's a more powerful combination than 2021. Silver ETF holdings are rising. When funds buy, they must acquire physical metal. That tightens supply. ETF buying creates physical demand. Physical demand drains vaults. Vault drainage creates price pressure. A feedback loop. Add geopolitical uncertainty, trade wars, conflicts, sanctions, and monetary demand for silver increases further. Industrial demand plus monetary demand flowing into the same limited supply pool. Pressure building. The lab's monetary demand conclusion. Silver isn't just an industrial bet, it's an inflation hedge meeting. Real shortage. Understanding the thesis is step 1. Step 2. How do you actually participate? Let's build a framework. Silver investments range from conservative to aggressive. Your choice depends on your risk tolerance and goals. Physical silver bars and coins has no counterparty risk. You own the metal. But storage and insurance cost money. Physical silver carries premiums. You pay above spot price to buy, receive below spot to sell. Account for spreads. Silver ETFs like SLV offer convenience. Trade like stocks. But you're trusting the fund to hold actual metal. Some ETFs hold allocated silver-specific bars with serial numbers. Others use derivatives. Know what you own. PSLV holds allocated silver in Canadian vaults. Redeemable for physical. Some investors prefer this structure. Silver mining stocks offer leverage. When silver rises, miners' profits can multiply. But operational risks exist. Mining stocks require research. Management quality, debt levels, jurisdiction, production costs all matter significantly. Consider diversifying across major miners, junior explorers, and royalty companies. Don't bet everything on one mine. Futures and options exist, but carry significant risk. Leverage can wipe out positions. Advanced Traders Only. The lab suggests building from the base up. Physical foundation, ETF core. Minor satellite positions, keep it balanced. Dollar cost averaging works well for volatile assets. Buy fixed amounts regularly, remove the timing guesswork. If silver drops after you buy more at lower prices. Your average cost improves over time. Position sizing matters. Silver should be a piece of your portfolio, not your entire portfolio. 5 to 15% range. Ask yourself, if silver drops 50% tomorrow, would I panic sell? Size positions, so the answer is no. Have an exit strategy before you enter. At what price do you take profits? When do you rebalance? Never invest emergency funds. Never use borrowed money. And don't torture yourself checking prices constantly. Thesis investments require patience. The silver supercycle may take years to fully unfold. Are you prepared to wait? That's your framework. Choose your vehicle, size appropriately, average in, and hold with patience. Simple, but not easy. Now the part everyone skips but shouldn't, the risks. In the lab, we examine what can go wrong. Risk 1. Volatility. Silver can drop 30% in weeks. It happened in 2020. It will happen again. From 2011 to 2015, silver fell from $50 to below $15. 70% drawdown. Brutal. Risk 2. Market manipulation concerns. Silver markets have seen spoofing scandals. Banks paid billions in fines. The paper silver market dwarfs physical. Critics argue this suppresses prices. The debate continues. Risk 3. Policy response. If the Fed raises rates aggressively, precious metals often suffer. It's happened before. A surging US dollar typically pressures silver prices. Dollar strength and silver weakness often correlate. If economic activity collapses, industrial silver demand drops. Remember silver's dual nature. In recessions, monetary demand might rise while industrial demand falls. The net effect is uncertain. Risk 5. Technology substitution. If solar panels or chips find silver alternatives, demand projections collapse. Risk 6. Opportunity cost. Silver could go nowhere for a decade. Meanwhile, other assets might soar. The lab doesn't hide risks. Volatility, manipulation, policy, recession, substitution, opportunity cost. All real. Every investment involves risk. The question, does the potential reward justify these specific risks? Only you decide. Let's summarize what the lab has found. The silver story has multiple reinforcing catalysts. Industrial demand surging, monetary demand rising, supply constrained, stockpiles draining, ratio favoring silver. Could silver hit $150 as Citi predicts? Possible. But predictions are not certainties. The lab doesn't make price predictions. We analyze data, identify trends, and assess probabilities. No crystal balls. Your homework. Research further. Understand your risk tolerance. Make decisions aligned with your financial situation. If this analysis helped you think more clearly about silver, subscribe to the lab. Share with someone who needs to hear this. Remember, in the lab, we don't chase hype. We analyze, we understand, and then we decide. See you next time.